Hi, I'm Wayne Blanchard. I'm a certified financial planner and a member of the Garrett Planning Network. Our topic today is the self-financing ratio. Now, where does this come into play? Self-financing traditionally means something like if you're going to have a scenario where you might self-finance, say, an insurance obligation. You see it also in terms of a scenario where, let's say, there are partners in a firm that are trying to figure out how much money is they're each going to take as a partnership in advance of earning things. They don't normally, when you're in a partnership, like let's say you're in a law firm or an accounting firm or any type of professional firm, you don't get money at that point based on how much you're really earning. Most people would like to have it, they'd like to set it up more like a paycheck. So they want to earn X amount of dollars per month. Well, how do they determine how much that ought to be? Where the way they normally do that is they will figure out what their expenses are for a particular year, and they will have all the expenses taken out. And then they will figure out, okay, how much earnings did this particular person bring in or is credited with over a certain period of time. A lot of times that's a multiple year period, like let's say 3 years is a fairly common number. So they'll look at how much profit did that person bring in for the last 3 years, what are the expenses that are allocated to that person, and they'll come up with some kind of a percentage that they would then be allowed to take. Now, again, that's the ratio. Once they establish that ratio, they'll say, okay, you can take 60% of what you used to earn. And of course, the rest would come as a quarterly bonus or an annual bonus or that type of thing. But that's what's referred to as a self-financing ratio. You can use the same kind of thinking if you were going to offer an insurance type thing for your policies. You hear about school boards and cities that become self-insured. That's what they use, a very similar kind of situation where they look at the losses and they say, okay, if we put away this much money, this is how we would treat it. And that becomes, you end up with a ratio there that determines how much money you put in reserves in order to pay those kind of things. So that's what your self-financing ratio is.